Recording in progress.
Hey, good morning, afternoon, evening, whenever it is you're looking at this video. My camera doesn't work because I'm going through my VPN this morning on my iPad, but I'm sitting at home today working on a spreadsheet and for a bond financing transaction, and I'm about to share my screen. Uh, so what I've done here is I have taken the sources and uses that I got from my bond underwriter. This is his sources and uses. And so what we've got here, we're using tax exempt bonds to refinance this property that we have in Louisiana. And we've got a Series 1, A1 of CABs, convertible activity bonds. Those are bonds that we don't pay full interest on those until we actually use those funds. In a lot of transactions with a construction loan or something, depending on the lender, you'll either pay interest on the capital, the whole stack of money that they're putting in, or only on the amount of money drawn. With the tax exempt bonds, it's the same thing. You're paying interest on all of the money from day one, with the exception of they gave us almost $4 million in cabs, where we don't pay interest on that money until it's drawn. So those will be the last dollars out. But we've got a total sources of 53 million. 13 million will be subordinated, meaning we're not going to pay that out today. Okay, here's my loan payout. But of this amount, we're subordinating this amount to leave some additional equity into the deal. So even with tax exempt bonds, there needs to be an equity component. Now, this property has a subject to value of $62 million on it. And that sounds like a lot of additional equity, like 12 million. But with this 13 million, we've got $25 million of equity in it. And so that makes the lenders buying the bonds feel a little bit more comfortable. We've got a $17 million rehab budget, a developer fee of $1.5 million, of which most of that will be deferred until the property stabilizes at year 2. Third-party reports, that's how much we actually spent on environmentals, appraisals, market studies, and et cetera. Not cheap. Taxes and insurance for the first year, because we've got builder's risk on this, is $1.8 million. 1.8 million divided by 452 units is, 1.8 million divided by 452 is $3,900 a unit just for insurance. Almost $4,000 a unit. Ridiculous. When we bought this property 10 years ago, our insurance cost on this thing was about $400 a unit. So it's gone up 1,000% from $400 to $4,000 a unit. It's nuts. Or gone up, 100% would have only been to 800. So it's nuts, right? Title premium for this size loans right at $288,000. Other title fees, $40,000. Architecture and engineering, we had to get some plans done, is $300,000. So we got 41 million is actually going to be funded at closing. Okay. Out of that, they've got a debt service reserve fund of $3.6 million. So that money will sit in reserves because that's about 1.5 years of debt service that the bondholders need for insurance. They're going to fund the operating account at day one with $200,000. Capitalized interest account, will be the amount of money that is used to pay the debt service for almost a little over 2 years, because our total interest is principal and interest is about 2.7 a year. So we've got over 2 years of debt service there as well. Plus, they set up another operating reserve account so that if anything happens, you got another $500,000 in reserves there. Total issuance cost for these bonds, including all the attorneys and all, is $1.5 million. And this is a standard cost of issuance for any bond transaction. That's about what you're going to pay, period. And so what I have done here is I have taken their sources and uses provided to me and incorporated that into my pro forma so that it matches line for line. Line for line. Total real estate costs, $41 million. All of the bond issuance costs and everything, including the debt service reserve funds and the capitalized interest accounts, come to $11 million. Total capital stack, $53,070,681. Now, keep in mind, they're only funding $41 million. My total appraised value today, assuming my appraisal says if the repairs were done today, the property would be worth $62 million. Okay? So we've got a $39 million loan. I called it, actually, it's going to be 41. And I need to change this total cost equals. Let's see where that came from. That is not what I want to do. Whoops. All right, let's go back. F196. F196 minus sources and uses D110. So I've got that number minus D110. Oh, D10 minus this number is how much they're actually funding. Is what this shows on my input tab here. Not true. So I'm going to do this different equals this amount because that's the true amount. All right. So 41 million, 100% of that, you could actually do the LTV of, if you took the 53 million and whatever your LTV was to come out here, you could use that number, but I'm gonna just use the 41 million because that's where we're at, 100% of that, okay? So that's my principal debt amount. My interest rate is right around 6% today, 35-year amortization. This is my total annual payment, principal and interest, 2.8 million. I showed you over here where we've got on the sources and uses, we've got 6 million in capitalized interest. So that means we've got a little bit more than 2 years here, okay? And if it were principal and interest only, it'd be 2.4 million. So why not do that? I mean, it's $400,000 more to the bottom line, but you start paying that debt down sooner. So we're gonna ride this loan out, and I'll show you on the pro forma how my debt service ratio goes from, well, here we are not fully occupied, so we don't have full expenses coming through to the bottom line. You'll notice here that I have my expenses net revenue. I've got my expenses dampened. So this OpEx dampening of 1.4 million means that my true expenses will be 2.8 million. But what I do is I have my expenses dampened here, OpEx dampening, 50% year one, 50%, 30% year two, because we're not fully occupied, so we don't need full maintenance. We don't need to be putting money into marketing and all of those things in year one. So I've got that dampened year one and year two by 30%. So that's why my debt service coverage ratios are a little really high, because we're collecting a lot of cash, assuming that. But year three is stabilization. We're at a 143 debt service coverage after stabilized. That's amazing. And it goes up to a 165 at the end of year six. I say we're going to do a refi at the end of year six. So we come back over here to year six on the refi here, end of year six. We've got a $75 million value. So we've grown the value from currently 25 million is what it's worth today. Put in $17 million worth of rehab. At the end of year six, you've got a $75 million value. And that's assuming a 6% cap rate. That's pretty good for Louisiana. We can go sell this thing at the end of year five or end of year six for 75 million and do good. Or we can refinance it at 73%. We pay off, here's my loan amount of 54 million. We pay off all the debt, including, that's the 41 million plus the 13 million that was done, and we got $2 million left over in proceeds. Or we go sell it for 75 million or 65 million, wherever we can negotiate that in the market, and it works well. You come down, you hold this property 10 years. 10 years, $85 million value. After paying off the 10 million up here with the refi, where you got 10 million, you still got 42 million left at 4 years after refining this thing. And this is an affordable property on the West Bank of Louisiana. On the refi, I dropped to a 114 debt service coverage, but then we come back up to a 120, 121. So this thing just makes money all the way down the line. Cash flow after debt service, you're $1.2 million, $1.4 million, $1.6 million, plus you got the refi paying off the 10 million. You put another 2 million in the bank, so you put almost 4 million, 5.5 million, 6.5 million, 7.5 million, 9.5 million in the bank over a 6-year period, play off 10 million debt, and then you cash out here 43 million at the end of year 10 when you sell it. So this thing makes 43 plus 10 is 53, 54, $55 million over a 10-year period for an affordable property with affordable rents on the West Bank of Louisiana. And this is my model. This is my spreadsheet that I made. And look, the rents. Rents are cheap. Average rents here, $1,196. Really, really cheap. So if you guys are looking for some consulting, if you're looking for a co-developer to help you with your project, hit me up. We can make something happen for you. I'm going to stop the share, and I am going to tap out, and we will see you on the other side. Dream on, dreamer.